Minimalist investing, how to build wealth without overcomplicating it. Why simple investing beats complex strategies. Investing doesn't have to be complicated. In fact, some of the world's wealthiest investors use incredibly simple strategies. Take Warren Buffett, for example. Despite having access to the best financial analysts and research, he advises regular investors to put your money in a low-cost index fund and leave it alone. But many people do the opposite. They chase stock tips, constantly check their portfolio, or fall for overcomplicated strategies that promise quick wealth but end up hurting their returns. So today, I'll show you a minimalist approach to investing that requires minimal effort, has been proven to work over decades, helps you build wealth without unnecessary stress. So let's get started. Why minimalist investing works. Minimalist investing is all about simplicity, efficiency, and long-term thinking. Why is simplicity better? Studies show that complex investing strategies rarely outperform simple ones over time. A Dalbar study found that the average investor underperforms the S&P 500 because they panic, trade too often, and try to time the market. The 3 core principles of minimalist investing. Invest for the long term. Short-term trading is risky and leads to emotional decisions. Keep costs low. High fees eat into your returns. Diversify and hold. Instead of picking individual stocks, invest in broad market funds. Example, the cost of overcomplication. Imagine 2 investors. Sarah follows a minimalist approach. She invests $500 per month into a low-cost index fund and leaves it alone. Mike actively trades stocks, paying 1% in fees each year. After 30 years, assuming an 8% average annual return, Sarah's portfolio grows to $750,000. Mike, because of fees and poor timing, ends up with only $550,000. Sarah's passive approach earned her $200,000 more, while Mike's frequent trading cost him a fortune. The best minimalist investment strategies. 1. The one fund strategy. Invest in a total market index fund. If you want the simplest approach, all you need is one fund, a total market index fund. Best options: Vanguard Total Stock Market Index Fund, VTSAX. Schwab Total Stock Market Index Fund. Why it works. You own the entire U.S. stock market, thousands of companies. No need to pick winners and losers. Your money grows with the economy. Ultra low fees, less than 0.5 per year. Example, historical performance. If you had invested $10,000 in VTI in 1993 and never touched it, your money would be worth over $130,000 today, without picking a single stock. 2. The two-fund strategy, adding bonds for stability. If you want a little more safety, you can add bonds. Best portfolio. 90% stocks, Vanguard Total Stock Market Index, VTI. 10% bonds, Vanguard Total Bond Market Index. This strategy protects you during market crashes while still allowing for strong long-term growth. Example, a 40-year-old investor using this two-fund strategy would have seen an 8% average return over 30 years, while reducing volatility. 3. The three-fund portfolio, global diversification. For slightly more diversification, you can use the three-fund portfolio. U.S. stocks, Vanguard Total Stock Market Index, VTI. International stocks, Vanguard Total International Stock Index, US. Bonds, Vanguard Total Bond Market Index. Why it works. Exposure to both U.S. and international markets. Protection against U.S. downturns. keeps fees low while increasing diversification. Example: a 30-year-old investor putting $500 per month into this portfolio would have over $750,000 by retirement without ever picking a stock. Automating your investments. The best way to stick to your investment plan is to automate it. Step 1. Set up automatic contributions. If your job offers a 401k, set contributions to 10 to 15% of your paycheck. If you don't have a 401k, use a Roth IRA or brokerage account. Step 2. Reinvest dividends. Most index funds pay dividends. Instead of cashing them out, set them to automatically reinvest. Example: if you reinvested all dividends in VTSAX since 1993, your total returns would be 30% higher than if you took the dividends in cash. Common investing mistakes to avoid. Even with a simple strategy, many investors make costly mistakes. Mistake number 1, trying to time the market. A study by Dalbar Inc. found that the average investor underperforms the market because they panic and sell during downturns. Example: in 2008, many investors sold stocks in fear. Those who stayed invested doubled their money in the next decade. Mistake 2, paying high fees. Many mutual funds charge 1 to 2% per year, costing you hundreds of thousands of dollars over time. Always choose low-cost index funds with fees under 0.1%. Example: a 1% fee on a $500,000 portfolio means you're paying $5,000 per year, money that could be growing instead. Mistake number 3, checking your portfolio too often. A 2022 study found that investors who checked their portfolios daily were more likely to panic sell during market drops. Instead, check your portfolio once per quarter and stick to the plan. How to get started today. If you're new to investing, here's how to start right now. Open a brokerage account, Vanguard, Fidelity, or Schwab. Choose a low-cost index fund like VTI or VTSAX. Set up automatic contributions. Even $50 a month is a great start. Leave it alone and let compound growth do the work. Remember, investing is a long-term game. The earlier you start, the more wealth you'll build with minimal effort. Minimalist investing is the simplest and most effective way to build wealth. Now, I want to hear from you. What's your current investing strategy? Let me know in the comments. If you found this video helpful, be sure to like, subscribe, and turn on notifications for more personal finance tips.